Vikas Khemani joins us now, President and CEO with Edelweiss Securities. Vikas, welcome to our studio. Good to have you here.
It's always good to be here with you.
क्या लग रहा है भाई?
So I think it's a very interesting phase of the market. As you rightly said that the breadth is missing, but the market looks to be touching new high, but it's only about 10 or 12 odd stocks which are contributing to the entire
Is there something
rise.
wrong with it? Because everybody is saying, okay, this should not happen. This is bad news.
No, nothing is wrong with that. It just does not show you the overall conviction in the overall breadth of the market. Nothing wrong with it. I think this is only temporary phase of the market. Primarily because of the lot of macro uncertainty, overhang right now. Because in this environment, last thing investors want is to be stuck with any illiquid scenario. So you have large caps which are liquid, delivering good earnings, robust future. So investors are looking more sort of defensive kind of ideas, which is I think explained by the rally in these top 10 or 12 odd stocks in the market at this point in time, which has contributed to almost rise of the Nifty of 800-900 points in last this year. So I do believe that till the time we have these three big macro uncertainty clouds over us, this kind of environment will continue. And as the uncertainty around the global rates and elections, oil price recedes, you will start seeing confidence coming back in the market and breadth getting built.
But do you fear at any point that or rather those 15 stocks in the Nifty may fall prey to the trend in the broader markets? Could the Nifty stall after making a peak, which should be just very shortly? We're almost there at the all-time top. Or do you sense it's the broader markets which are going to catch up with those 15 names? Or do you think this distinction between where the broader market continues to slump, those 15 stocks continue to hold the Nifty up, that divergence will continue?
It very depends on the liquidity and overall how the macro factors turns out. Let us say if the liquidity profile, domestic liquidity and overall liquidity profile towards markets changes, you will see all these stocks also probably giving up some of these gains, because that will not have to necessarily only to do with fundamentals. I mean, fundamentals of many of these stocks have remains same for quite some time. I mean, TCS is up 40% in last few months, and and they've been guiding earnings growth reasonably well for last 3-4 quarters. So I think it is a lot to do with the liquidity profile. If that were to change, you will see these stocks might also give in. But I think given the defensive nature of the market, given the lot of cash sitting with the mutual funds right now, I think most of the mutual funds are at 8 to 9% kind of cash levels. You will find this is more hiding in some of these names where even if you have confidence in some of the mid cap or smaller caps around the earnings and all, you are not finding, given the macro environment, confidence to go and hide there or invest into that.
So you're saying there's a higher chance that broader markets will catch up with the index, right?
Absolutely, absolutely. The only caveat I would put is that if something untoward were to happen in a global environment and all, then we do not know. Then you might want to see. And this is the uncertainty which is defined this market, and this probably will continue over next 6 to 9 months as we see.
What will drive that uncertainty to your mind? More global cues? I mean, what's the big risk in the market right now?
So as I said, there are three big risks. One is oil, which is specifically for India. It is a very big risk. If the oil price for some reason, and especially 4th November when the Iran embargo kicks off, how the oil price scenario will, as we move towards and as that event takes place, how the oil price scenario takes place, that's a very big risk. If let us say oil were to go towards 80, 90, 100, India is in a very tight spot, and we might see some implications both on inflation and interest rates. Second, I think is we have big elections coming up, and that uncertainty looms large over our entire policy front. So how and markets would be nervous till then. And thirdly, I think how the currency pans out. Obviously, due to trade wars, we are seeing a pretty uncertain environment. So how those events sort of take place. Some of them you might get some clarity over next 3 to 6 months. Some of them might still continue to remain that. But I think elections and I think at least oil price, we think that probably you will get some trend and some clarity around that, and these clouds will have to settle down.
Okay, let's talk about what could support the markets at these levels, and I think it squarely boils down to earnings. Within earnings, we've seen IT roll the red carpet. TCS came out with a great set of numbers. Do you think that can be followed up with what the other IT majors do? And So that overweight position only builds on IT from the start of the year till now, post these earnings
So
call?
we think earnings recovery is on way, and we are seeing a broad-based recovery happening. If you were to take out the corporate-facing banks, where or PSU banks out of the Nifty, you will see almost 25% plus earning growth in this quarter, and that kind of profile which we've been waiting for a long time. So I think definitely earnings growth are is happening. Demand recovery is there. We have seen automobile number. I mean, across the board, you are seeing consumer automobile number picking up very well. So we think that IT, automobiles, consumer stocks, bank, especially the private sector banks, NBFCs will continue the earnings momentum. Specifically to IT, I think in our opinion, IT is on a recovery for next couple of years at least, because I think the recovery has just begun. The order book is very strong. Most of the companies are guiding that the demand scenario is very strong, and currency weakening only helps them. So in that sense, I think IT trajectory is here to stay for a couple of years.
But are the stock markets already factoring in that, or is there still scope to jump onto the bus even now and still make money?
Of course, as long as you are clear about earnings growth, it is going to continue. I think markets are not like to leave it. It is going to continue. We have seen how stocks, when they are expensive at one point in time, continue to remain expensive as long as the earnings growth continue. So I think still there would be funds who would not be invested into IT, or would be underweight IT, or would want to increase weight of the IT. They would come and buy. So we have seen this trend. I mean, we've been saying this for 1 year about that. We've been bullish on IT, and we've seen how slowly this outperformance has happened. How funds have increased their stake. So I think this, as long as the earnings continue, I don't think there will be any letdown in IT.
I'm checking out the top traded counters right now, purely in terms of value. It is TCS, Reliance, Infosys, HCL Tech. It's not Fortis. It is not any of the mid-cap stocks. So bulk of the money we know is migrating, and it is migrating in which direction? Because I was looking at a very interesting report yesterday, and in hindsight only we can figure out what works and what does not work. 1 lakh rupee invested in Bajaj Finance in 10 years has become 1 crore plus. 1 lakh invested in Aisha Motor has become 1 crore 20 lakhs. 1 lakh invested in Grahu Finance, small, simple business, has become 85 lakhs. Now, we can only figure out after 10 years which are the next stocks which will give you this kind of a return. But markets, you have to work with probability, you have to work with cycles. So if you have to, let's say, make a lock and key portfolio where you can see earnings visibility which is available at a reasonable price, and the combination of management is there in today's disruptive world, what would you like to buy today, assuming that we will talk about it in 2025, and these can give you a 20-25% return?
Surely, I think, in my opinion, definitely some of the private sector banks would be there. Still it would be there, because I think what we have seen is just a beginning of a very big financialization program and shift of market share from public sector to private sector.
Okay, so I have a follow-up question, then I'll go to a second theme. I like to split the private banks into two now. You got corporate banks, you got retail banks, and now you got new age banks. You got something like an AU Small Finance Bank. Yes. Ujjivan has become a bank. Bandhan has become a bank. So would you stick to an HDFC? Or something like Kotak Mahindra Bank, or you would say that, look, I'll buy a Bandhan, I'll buy AU Finance, I could buy Ujjivan. Where do you think that bulk of the money within the private enterprise will be made?
So I think all of these banks will do very well, because everybody is playing in a niche segment, a small segment. I do believe that even HDFC Bank or a Kotak banks, even they are large market cap, they would still give, in my opinion, 18-20% return over next 10 years. Okay. That's the kind of growth profile we're sitting. And go back, I mean, HDFC Bank, 10 years ago, people used to talk about being expensive, and every year it has delivered. So I think as long as there's opportunity and organizational, is geared to kind of capture that growth, I do believe that, and these are some of the very, very fine organizations, some of the names you mentioned. Some of them you might argue that are very, very expensive, but I think, that answer is never there. I mean, in that sense, iShare, we always believe that it's expensive, but it keeps on delivering return, right? So I think it's better to stay in a little expensive name with good management, good business model, and who has delivered continuously year after year. So I think these kind of names, most of the names which you mentioned, I do believe that will be very, very large companies 10 years down the line, and they would definitely compound.
Where does it leave the alpha opportunity in the market then? Because, with compounding names, you'll get consistent returns, but you're looking for that value play where you can pick the stock at the right point, well, relatively right point as you see it in your judgment, and, ride the wave as and when it comes through.
So for that, I think if you have to seek value, you
is this market ripe still for those kind of opportunities?
Sure. I mean, I do believe that in mid-cap, there are lots of, value plays, after some of the stocks have corrected 50-60%. I mean, those business models are not broken. They are still there. I mean, just because of the liquidity profile changing and some of the clouds right now around us, Those businesses are going to stay here, they will be there, they will grow. So, but only thing is, to get that right, you have to get the cycle right, you have to have your, you have to put up with a lot of patience and risks in those names. To get the, value at a right point in time, you have to track. Typically, you will find that into cyclicals, typically you will find them when, this kind of sell-offs happen. But they might test out your patience before they start delivering, and that is the key characteristic you have to have when you are looking for a value pick. And I do believe that today also in mid caps there are lots of names, lots of stocks which are offering fairly good amount of value, and as the clouds kind of phase away,
anything
you will
new
see
that has come on your radar? I mean, not from a buy sell perspective, just as as a story that you're fascinated by.
I mean, some of the chemical companies, I mean, recently, like we took this company public, Fine Organics. You look at that company; it's one of the great company. They have historically delivered, continues to deliver. Global company, Indian MNC. Their margin profile is like a consumer company. ROE profile is like a consumer company, and keeps on delivering year after. And still, it's very tiny company. Can that become fairly big over next 5-10 years? Answer is yes. So I mean, these are new segment emerging. I mean, in chemical space, I think probably there's a huge opportunity going forward. So you will find many of the pockets of a similar name was Galaxy Surfactants, where and I can give disclaimer because we were bankers to both the companies, but these are the pockets emerging, and they will create compounders over, and they are very fine companies, good balance sheets, no debt or very little debt, so you will get them in this kind of market only at the right valuation. In a bearish market, you will get them at 30p, 25p, and you will probably carry those kind of risks. But this is the time to kind of build portfolio, which is where you are getting these kind of names at a reasonable price.
Because I recall about a year and a half back when we were chatting, you said that the big picture in the market is A, of course, the financialization theme, which you still continue to like, and the B, in anticipation of GST, was the shift from unorganized to organized. Is that still a theme that you're betting big on, or do you think the story is done with over there?
No. I mean, this has not even begun. I mean, e-way bill has just started in, and that has actually slowly changed the game in favor of organized players. Please, and again with this correction, you will get some of the names which are there in the mid cap space, which are part of this theme, which will benefit from this theme. And I do believe that this theme is not a 1-year theme, 2-year theme. This is going to play out over the next 4, 5, 7 years. And this theme is not only because of regulatory aspect. Regulatory aspect is only one part. Premiumization is another aspect. Technology development is another aspect. Brand or related issues. So there are multiple aspects to this.
So dairy, tiles, shoes, textiles, all of it.
Absolutely. I think you will find many more. In this. I mean, yesterday one promoter was in our office and he was in the plastic industry, and he was saying that earlier they had 28% tax and 14% was sales tax. Now the sales tax earlier or unorganized player could sort of evade and be more competitive. Now the only tax is 18%, and they are getting input credit. So that has made unorganized player completely unviable, especially who were kind of
Let me give you an example of a company you took public. I remember you were part of the opening ceremony, Sheila Foams. Yes. We had the management 2 weeks ago. He said, look, by GST is great, but it's not that anything has changed in last 1 year, and we don't think anything will change for next 12 months. Then after that, we had the management of Century Ply. They also admitted the same, that GST is good, we are happy, but it has not translated into anything meaningful so far, and it may not translate into something meaningful going forward also. So my question to you is that we both know that this is a factor which is at play, but are markets pricing in lot of good news? I mean, markets are, when I read analyst reports these days, they're simply working on Excel. 20% assume, 3% for no, I mean, वो number चला रहे हैं basically.
That's so you are absolutely right. It's a very, I think, worth examining this thought. See, I think good or bad part about a market is that we expect, things happen too fast. We say demonetization happens, so we expect that, black money will go out. We have GST, we expect that, everything will be tomorrow. I mean, there are times when I am asked questions that, how come unorganized share is not moving? Please understand, it's this entire ecosystem, it takes time. We had GST implemented, e-way bill has just got implemented, right? Now, that also will have its own challenge. As you know, we have a lot of innovative minds in our country as far as the tax evasion is concerned. I'm sure you have heard stories. Now, all those things takes time. And plus, we are into election mode, so government will also have its own challenge in terms of being very tough on, tax evaders, right? So, I think, we should give it, please understand, whenever GST has got implemented in any of the countries, it has taken long time to, sort of implement. A lot of time people say bankruptcy code came, nothing has happened. In UK, it took 12 years to implement. Now, Now, in first year we are expecting here miracles that all NPA problem will get solved. So I think in that sense, I find our markets a bit impatient in terms of expecting. It is directionally very, very good move. It is going to have impact only, in my opinion, over 4, 5, 7 years in a meaningful manner. Of course, markets factor in, I think if you were sitting in January, probably markets were giving full credit to what was expected. Today, I think when markets are expecting the fact that those stocks have corrected 30-40%, they are not giving that kind of, credit to same trend. So it is, I think, more to do with the, in my opinion, market sentiment environment than really. Everybody knows that, GST kind of reform cannot be implemented, overnight.
So I have a follow-up question, and my last question is, I was looking at the best performing sector in last 10 years, and the best performing sectoral index in last 10 years actually is the auto index. A lakh has become 6 lakh in the auto index. It's not happened in FMCG, it's not happened in metals, it's not happened in real estate. And this 10-year comparison is coming on back of this financial crisis. So the gains, of course, will look very high. It's not going to repeat itself. So that brings me to my broader point, which is that the India story is centered around banks, private, autos, and consumer. That is the story. Combinations may go, we may buy this, we may buy that. Sometimes it's Zero Motor Corp, sometimes it is iShare. But that's how you have to really weave around the India romance. So if you have to make a 5-year portfolio, what would you like to buy in that portfolio? One is private banks. What else? Private banks may be 30%, but what about the remaining 70%?
Nikhil, I can also summarize a little bit how you summarize that. Probably in that sense, another way to cut is that, India's story is about savings, consumption, and exports.
Fair point.
So I think what you mentioned was savings and consumption, and I think right now, given the global environment towards IT, exports are doing really well. So I think, and you will have different kind of, but if you ask me, my personal view that your 70-80% portfolio has to be between savings and consumption theme.
Yeah.
That is what India's story is.
So savings is, how do you play savings?
Savings is through financialization, right? Through the banks, through the, all the, asset management company, insurance companies, so the entire, because if you save, that needs to get channelized through, basically savers of the capital give capital and users of the capital get capital. So there is an in-between pool through various vehicles. So that's the only way to play, and I think that will pan out, and it has panned out. I don't know the number, but I'm sure in the last 15 years, this segment also has created much more wealth than even probably automobiles. So they will play up. So I think financials and savings financials and consumption should constitute almost 70-80% of the portfolio. Exports, you should go, because I think that's also a story for us. We are seeing great export stories, as I said, in IT, in chemicals, and so it's picking up. As China loses the steam and has the cost of labor and going up, India is becoming more competitive in many segments, and that story will also play out. So I think I would say this is how I would say, and this is going to play out.
So it doesn't bother you that consumption is expensive? No, you're willing to pay that price.
It has worked out and it will work out. So it doesn't bother me too much, to be very frank. Obviously, you have to play everything keeping in mind, but consumption is defensive consumption. You can be reasonably sure that as long as the company does not mess up, you will get your 15-17% growth. That's the one segment you can, because there's no leverage, demand is going to be robust. Once you are a branded player, generally it's not easy to destabilize brand immediately. In fact, rather in this kind of environment, you can build, like what you look at what Britannia has done from a small, not a poor growth environment. Suddenly, organization has changed because they've invested into organization building, brand, and everything else.
Okay, we completely run out of time. But what's music to my ears is that you like media companies. We keep discussing the future of media companies, right?
I love to talk stocks, but right now I will not talk
stocks. We're not going to get into specifics, but you like media, there's potential there?
Of course, I think media, they see, again, whom do you buy? Content provider or, so there's this whole, I can have a discussion.
So who do you buy?
But media is definitely, again, part of the consumption. Our consumption of media is going to go up. There's no question on that. Now, who will benefit is a question. Content provider will surely, rest, one has to be debated.
Okay, thanks, Vikas. Thanks very much for stopping by and speaking with us. That was a great conversation with Vikas Khemani, President and CEO of Edelweiss Securities.